Welcome to part 3 of our series on market cycles. This one we're titling Forex Cycles Trading, but it also applies to stocks, futures, Forex, really pretty much any type of market. So let's jump right into it because this one I'm very excited to share with you. This is one of those cycles that is rarely talked about. In fact, I hardly hear anyone talk about this, and yet it is one of the most important. So we have talked about calendar cycles, and we have talked about high volatility, low volatility cycles. Well, this one is what I call my order chaos cycle theory. And it basically means this. Well, let's start out with a little example here of where this comes from and how it all ties together. So first of all, there's one theory that the market is a random walk. In other words, chaotic. Random. And you've probably heard of the book Random Walk Down Wall Street if you haven't even read it. So it's a very popular book, very well thought out, very well researched, and it is a good book, and there's a lot of truth to it. So basically, the author said that everything that can be known about a market is already known, and therefore the markets are already perfectly efficient, and therefore you can't get an edge in trading or in investing. Okay, so that's one theory. Another theory is exactly the opposite. And these people say, oh no, the market is perfectly orderly and predictable, and they'll often use mathematical models, often geometrical models. And here you're getting into schools of thought such as Gann, probably the most famous, and some followers and people who followed up with his work and maybe altered it a little bit, and basically saying, oh, we can predict the market 5 years out, 10 years out, 20 years out to the exact day, time, and price. So two completely opposing point of views, and some of them even have some history to back up some predictions that they've made out into the future, which were pretty darn accurate. So obviously I've read both of these positions, and when you read each one, then each one seems very convincing. They show a lot of examples, and you can say, yep, that worked, that made sense. But then when you get done reading both sides of the research, you're stumped because they're completely and utterly contradictory. So as I was doing this, I realized, wait a minute, as I'm looking at these examples, yes, they both have examples that support their positions. So there might be an issue here where sometimes the market is a total random walk, and other times when it is very orderly and predictable. And so I came up with this idea that there is a cycle in the market, another type of cycle, where the markets go through a period of being orderly, and then they go into another period of time where they become very chaotic. While they're chaotic, they are unpredictable, and you cannot establish a probability scenario, and therefore you should not be trading them. On the other hand, the times we do want to trade is when the markets are very orderly, and then we can provide a probability scenario. So this is why overtrading is one of the cardinal sins, is because people can trade for a while. Maybe you've had this experience where you've traded a methodology and it's worked for a little while, and then all of a sudden it seems like it stops working. One of the reasons for that may be that while you're trading it, the market is in an orderly cycle, and then it goes into a chaotic cycle, and so yeah, your probability scenario goes away just because the market is in a random walk during that time. And nobody's taught you about these cycles. So if you're trading during both cycles, then that is then you're going to be overtrading because you should only be trading during orderly times. And so this is the foundation of waiting for what I do. I wait for the alignment of what I call 5 energies in the market. So that's the question. Well, how do we determine now when we have an orderly cycle? When is the market moving in a rather systematic, orderly? I don't like to use the word predictable, by the way, because that assigns too much certainty to what we're doing, but a probability, which is really all we need. All we need to exploit that probability over a large period of time is what makes us money. So here's how I determine an orderly cycle. I'm looking for the energies in the charts. Now, by energy, I mean the energy of money. Money flow, buying, selling pressure, selling pressure, volume, the speed of the orders, and things like this. So I break the energy of the market down into 5 subsets. Now, you could add more to this, but here are 5. And these 5 are important, and I'll show you why in a moment. But first, let me just give you the list. So step 1 in my trading method is trend. And I always trade by going right through this checklist. Really, it's just a checklist. Start with step 1. Okay, what's the trend? Good place to start because I want to know which side of the market I should be on, long or short. Number 2, trend is not enough. A lot of people think, oh, you just trade with the trend. No. There are 2 types of trends, strong trends and weak trends. A lot of people have never been taught that. Again, that is a huge vacuum in your knowledge of trading, and you will lose money unless you learn how to determine whether the market has momentum behind it, because momentum is strength. And if a trend is weak, it will fail. It will fail. The trend is your friend until the end, and you will be getting in at the end. So you must always ask yourself a question. In fact, I'd encourage you to write this down, even put it on a Post-it note and put it on your monitors. And here's the question. Is this a strong trend or a weak trend? And ask yourself that question every time before you take a trade. Step number 3, cycle. So now that we have a trend and it's strong, then we go to step 3, but only if we have step 1 and 2 in place. Then we say, okay, now when do I want to get in? I want to buy the final cycle low so the market doesn't make another low after I bought. In other words, I don't want to get stopped out. Oh, by the way, that's where my cycle indicator comes in, which I do give away for free. I offer it through a live webinar. At least at the time of this recording, I'm still offering that for free. And it takes about an hour to explain it, and not only how to get it set up in your charts, but how to trade it. So we modify an indicator that's already in your charts to turn it into a cycle indicator. And then I show you how to trade it, which is very, frankly, counterintuitive. That's why we do it on a tutorial on a webinar like that. Okay, so if you want that, just send me an email, Barry@TopDogTrading.com. And like I say, if it's still available, whenever you write, we'll let you know the date and time of the next webinar. It's all for free, 1 hour of free training. Now, step 4 then, okay, we got a trend, it's strong. We've got the time to get in. We just want to make sure that we're buying at a support level or shorting at a resistance level. And that's all on the short-term chart. Then number 5, I look at the longer-term time frame, and I want to make sure I'm trading in the direction of the strength or the momentum of that longer time frame. Not trend. I don't care what the trend on the longer time frame is. Couldn't give a mouse's left patootie. So that's one of the heresies of traditional technical analysis that I violate. But it's not the only one, by the way. But hey, if you're making money with traditional technical analysis, God bless you and the horse you rode in on. Most people aren't. And by the way, there's a reason for that. It's not that it's no good. It's just that the markets have changed since those rules were written. So now markets move very differently, basically because of technology, computerized trading, algo trading, commoditization of retail traders, direct access, high-frequency trading. All of this stuff has dramatically changed the way markets move since the establishment of traditional technical analysis. So you've got to keep up with the times. So trend on the longer time frame no longer means anything. It used to work, no more. So I wait for the alignment of these 5 energies. Now here's the key. As I measure these, we're going to use indicators, not because indicators are any kind of magic. They're not magical. They're just mathematical. But I use them because being mathematical, they give me objective measurements so that I don't have to be a discretionary trader. And indicators themselves don't make us money, right? They do what they promise. The answer's in the question. They indicate. So, but they do give us an exact value so that our energies, or the measurement of those energies, is objective, rule-based, and duplicable. So when I share this with other people, they can do it as well. It's not just that, oh, I'm good or I've got some, magic skill or something. So here's the bottom line on how this all then creates a probability scenario. At each point I'm looking to possibly take a trade, I simply ask myself how many of those 5 energies are aligned. And I give each setup a score of 1 to 5. Now, the higher the score, of course, the higher the probability of success. So I liken this to taking each trade to court. But here's the key. These particular 5 energies were strategically chosen because they are independent and uncorrelated to each other. That's why these 5 energies, as I said in passing earlier, you can use more than these 5 energies of money flow. There's other ones. But these 5 are special because they are very uncorrelated to each other. And that's what makes it significant when they're all bullish or bearish. That gives you a preponderance of the evidence and gives you a probability scenario. So that's when we then say, oh, now we have an orderly cycle in the market. We are in an orderly time. The market is moving in an orderly manner. We still have to use our stops. We still have to hedge our positions because anything can happen at any time. News, rumor, gossip, heck, computer glitches, whatever, right? But that's okay because we can survive those as long as we use good risk management and money management. But this is how I establish a probability scenario, by finding cycles that are in a time of moving in an orderly way that gives me a probability scenario. So if you like this video, please understand that, yep, it's free, but if you got value from it, then you should pay that value forward. And the best way to do that is click the share button below. If you're watching on YouTube, please subscribe. You'll get notified every time I release a new tutorial, which is about every week. Click the thumbs up icon and leave a comment. I really love your comments. I've got a special offer for you if you'd like to learn more details about the 5 energy method. I had to go through it real quick, about 10 minutes here today, so obviously can't go into all the details. Just want to give you the overview so you get the concepts. But you can get all the details of it. Best place to start is to start for free with me and just get my rubber band trade. And I give that trade away. It's absolutely free. It tells you where to get in and out and where to place your stops. All that stuff has a very high win-loss ratio. And I want you to start making money immediately without having to pay me anything. So this video is about 26 minutes. You get my rubber band trade strategy absolutely free by clicking on the image in the top right corner of this video or in the description below the video. Or if you happen to find this video somewhere other than YouTube, there's probably a link below or an opt-in form on the side. And once you do that, I'll personally email the video to you with the rubber band trade strategy.